The Fed just increased their interest rate by 3/4 basis points, 0.75. I'm Brad Decater with the Decater Home Team. I am not an economist, but I wanted to do a short video here about my take on the Fed's most recent meeting. I did watch a part of it, then I watched some recaps of some people that I trust their opinions on. So again, I'm not an economist, but hopefully for some of my past clients, friends and family and colleagues, this will help you understand if you didn't have time to watch it yourself. So I have 5 points that I'm going to go over. I'll try and do them pretty quickly to get the take on the federal fund rate hike. So first thing is that the hike was made. So 0.75, which was to be expected. Some people thought they might be a little bit more dovish because the markets are obviously have been reacting over the past few months, but that is not the case. And so my first point is based on their outlook. So the Fed, it appears not going to be backing off at all. In fact, he specifically said, Chairman Powell, he said, "I would rather over tighten than not tighten enough." So they are definitely consistent with their plan to continue to raise rates to then get the inflation down to the 2% target rate, which is what they have. The CPI rating did not have a very good showing, and so inflation has not been coming down as they were hoping for. So they are definitely sticking to their guns and sticking to their plan. They're going to continue to raise their rates until we can get to that target number of 2% inflation. He did mention, though, if things, because they're always changing their plan based on data points and what the CPI is and other, unemployment things that are coming into their statistics to then analyze what their plan is. So he said they definitely are not in a position where they're even considering any sort of pause. However, they might decide to just lessen their rate hike. So maybe, December is 0.5, and then maybe it's just 0.25, 0.25, 0, 0.25, something like that until we get under control. But again, he did say he would rather over tighten. He even mentioned, "I would rather over tighten and then turn the money printer back on." So over tighten and then use stimulus to get back, as opposed to the opposite, the alternative, which is just to not do it enough and have inflation never get under control. So my biggest takeaway from this is that definitely they are consistently going to be, doing the rate hikes and trying to get inflation under control, which is the whole point of what they're doing in the first place, get inflation down. So another very interesting point that an analyst had spoke about on the video that I watched was about the CPI rating and shelter specifically. So I did not know this at all. So this is news to me. Didn't do a ton of research afterwards, so hopefully it's true. But if you take out shelter, which it says it makes up about 30% of the CPI rating, that would be rents and pricing in real estate. So shelter, since it has such a huge impact, if you took that sector out of the CPI rating, we would be actually close to zero. So someone asked the chairman in the interview there, or after he made his announcement when they were doing questions and answered, they said, "Are you aware of this? If you took out shelter, that we'd be right about zero, which is below your target." So anyway, he acknowledged that that is correct, that if you took shelter out, that it would be a completely different CPI rating. However, he still thinks there needs to be a reset in that, and he is very focused on the overall CPI rating, even though it appears that things are working in one sector, not so much the housing at this point, although it has started to, but they're looking at year-over-year stuff. So because we had a crazy spring, it hasn't quite caught up. That's why it's, again, a lag measure. He also, for the first time that I've heard in a while, said that rents, I think, are actually, they have a little bit more to go up, but they should be coming down as well. Rental rates, that is. So, housing prices and rental rates. So the last point was based on analysis of the Fed's meeting, which I thought was very helpful, and this was about unemployment, and I couldn't agree more. Basically, he thinks that we need to see unemployment go up in order to get control of this inflation. And so his example, which I thought was very true if you think about it, the Fed's raising interest rates does not impact the consumer. The consumer is the most lagging measure possible, because they do their short-term rate, and only businesses and big companies and banks are trading at this specific interest rate, the federal fund rate. Mortgages, 30-year fixed mortgages, car loans, all that other stuff is tied to it's correlated, but it's later. It's a lag measure, and so they don't see the outcomes of that until later. The mom and dad, they're not skipping steak dinner tonight because the Fed made their announcement, but they are skipping steak dinner when they lose their job. And what happens is when the Fed makes their first ripple effect, then businesses are going to be the first to tighten because they're corporate money. They're borrowing them a lot of money. They're creating jobs and trying to be in growth mode. But when they tighten, then that's when job markets is going to change. And then that's when people lose jobs, unemployment goes up. That's when we're in a serious recession. And that's when people stop spending the money on the steak dinners and all the other luxuries. And that's when, of course, inflation comes down. So I thought that was very interesting. So, overall, they're not stopping at this point unless things drastically change in the statistics that they're receiving, but they are kind of staying the course, and it appears to me, on my own analysis, based on the stuff that I listen to and what I already know, it's going to get a little bit worse before it gets better, but I do think it'll get better. Real estate's totally different. Very, very hyper local. If you look at all the headlines of national statistics, real estate actually hasn't gone down significantly yet nationwide. It has pretty significantly in our area. So real estate's always very hyper local. So keep your eye out. The statistics just came out in the MLS today for October. So I'm going to do a real estate market update specific to real estate. We'll mention some interest rate stuff as well in my next video in a couple days. So hopefully that was helpful. If you guys have any questions at all, definitely reach out. I now have the Calendly link in the bio or the comments or something. So if you want to book a 15-30 minute call strategy with me, feel free to do so. And thanks for watching.